Hello there. Thank you for joining us today. My name is Marcia Butler. I am the webinar director here at Advice Chaser, and we want to thank you for coming and welcome you. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're so thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And this webinar in particular is really good for questions that you might have, and we'll be able to hop around in the content and address those. So that is a feature I do need to turn on. So I'm going to go ahead and turn that on now. And it should be turned on, so you should be able to chat with us. If you ask a question in the chat box and we're not able to get to it, please leave your contact information in there and we'll make sure to reach out to you after this event has closed. Again, we want this experience to be as educational as possible. So don't hesitate. Please ask questions, ask for clarification, expansion of the material. I'd love to introduce you to our presenter today. Eric Maldonado is the owner and founder of Aquila Wealth Advisors, LLC, in San Luis Obispo, California, established in 2017. Eric has over a decade of experience providing financial planning and investment advice. He is a fiduciary financial advisor and a fee-only financial advisor. That means Eric and his team work under a fiduciary standard of care, putting their clients' interests first, and their compensation method is the most transparent and objective method available. Eric earned his MBA master's degree in financial planning from Indiana Wesleyan University and his bachelor's degree in business administration finance from Cal Poly San Luis Obispo. In addition, Eric has designations of certified financial planner practitioner and certified exit planning advisor. And Eric, I'm so excited to have you back, and we're going to turn over the time to you.
Marcia, thanks for having me, and thanks for everyone on the call. This should be fun. Some entrepreneur questions, Q&A. As Marcia mentioned, please feel free to put questions in the chat. We'll get to them, we'll answer them all, or at least attempt to, and flow through some really important topics as an entrepreneur. So if you're here as a business owner or a future business owner, you're in the right spot, and no question is off base when it comes to the business ownership type questions. So feel free to bring them on. But we can start in here on the next slide, Marcia, and I think we're going to look at like risk planning or protection planning. It's kind of a good place to start, right? If you're going to start a business, a lot of people think in terms of like, okay, what kind of risks are that? Or if you even already have one, where do I focus to make sure I'm not too exposed one way or the other towards some sort of a liability or financial calamity. And even the word risk, I mean, you could take that a few different directions. Risk of like not having enough customers, risk of a lawsuit, risk of maybe not providing for your own personal well-being in your family from a wealth standpoint. But for now, we'll look at financial risk from like a liability standpoint, maybe the traditional way to look at it as far as protecting against catastrophe. So an obvious place to start for a business owner would be to get like an errors and omission policy or like a business liability policy. You can typically connect with any property casualty type insurance agent. Maybe if you have a relationship with someone that does like your auto and home and other stuff, they might be able to point you in the right direction for starting the conversation of getting a business liability policy if you don't already have one, or if you have one, making sure you have the right amount. And then, so that's kind of the insurance side of things. How do I protect myself? You can get more into personal policies, whether that's a disability income policy for your own person, if something happens to you and you can't work, life insurance, things like that. So that's kind of touching on the protection piece.
We did have a question here that has to do with this. They said, I'm a LLC and I understand that that should protect me from any kind of lawsuits that come at my business. Can you talk about LLCs and other
Yeah,
entities?
yeah, absolutely. And we'll even get to entities here. That might even be the next slide, which is the entity selection and how to go about choosing that and how does that relate to protecting me. So I'll kind of flow through an example of even a progression of business owners. The easiest is to start with a sole proprietor. So you're your business and the business is you. There's no separation between you and the business, which means from a risk standpoint, a liability standpoint, I mean, you are fully exposed, quote unquote, to any kind of, litigation of any sort, your whole personal wealth, your house, any other assets you have. And then the next easiest step, if you will, towards separating you from your business is just an LLC, a limited liability company, or a limited liability entity, which it does what it sounds. It limits your liability from your person and separates it from your business. So now you have an LLC, which would have a separate bank account, a separate employer identification number, a tax number, and you start separating things so it's clean and different from yourself. And then within an LLC, you can actually choose at a later point to select as an S Corp or a C Corp from a tax perspective. So maybe one misconception people have is that an LLC is a tax savings tool. But the reality is the LLC doesn't really affect your taxes because the default choice for an LLC is just to be a disregarded entity or a sole proprietor LLC. So essentially it just all flows through your tax return if you're an LLC and you haven't elected to be incorporated as an S Corp or a C Corp. And an S Corp allows you to then have payroll and you have your W-2 income, and that's separate from any profit draws you take from the business. And the benefit of that is profit draws or distribution from the business aren't taxed payroll tax wise, so they don't pay Social Security and Medicare, whereas W-2 salary that you choose from your business, it is taxed roughly 15% for the self-employment tax. So that's kind of the business entity selection. You can, of course, go straight in and choose an S Corp, like start your business as an S Corp and incorporate right away. But oftentimes from a business startup standpoint, people want to kind of work their way into that. Because an S Corp, you're supposed to pay yourself a reasonable salary, right away, quote unquote, reasonable is what the IRS calls it. And if you're in startup mode, you might not be able to pay a reasonable salary as you're just building the business. So those are some
Yeah, that goes to one of the questions we got in the chat here. So this particular individual says, it's the owner of an LLC where I'm the sole owner. Excuse me. Should I establish a W-2 for myself? Can you with an LLC, or do you have to be like an S Corp?
Yes, great question. Thanks for asking that. So with an LLC, if you're kind of the default mode, which is a disregarded entity or a sole proprietor, then there is no payroll because there is no separate entity. Basically, whatever comes into the business minus expenses is your profit, and that goes, straight to your 1040 tax return as federally and state taxed. But then that profit is also needing to pay self-employment tax. So there really is no like strategy as far as W-2 goes because there's no payroll. Now, when you are an LLC, you can submit a form and elect to be an S Corp, to be recognized as an S Corp from the IRS while being an LLC. So that's why it's kind of confusing because you could be an LLC and an S Corp at the same time. Your entity is the LLC, but from a tax perspective, your tax is an S Corp, And the benefit to that is now you can have payroll and have a W-2 income and a formal salary that you basically decide at the beginning of the year what you want to pay yourself per month or every 2 weeks. There's certain like payroll software that you can use, like Gusto is kind of a popular one that automates a lot of those W-2 and payroll forms that you have to submit through the state to be compliant, or for like the Department of Labor. So that W-2 then becomes like your consistent salary, almost as if you were a salary employee for any other business. It starts to formalize it for you. And then you can still take owner draws quarterly, for example, and those would come to your personal account from your business outside of payroll. So that wouldn't go through, the normal payroll tax parameters. Good question.
I'm gonna pop this one up because it seems like we're going into like this
Yeah.
realm anyway, and I want to kind of keep on this vein.
Yeah.
So what you're saying is that you can pay yourself that reasonable salary as an employer paying an employee, and then
Yeah.
also as an owner, basically have like a profit kind of distribution at certain times of the year.
Yes. Yeah. For owner pay, a lot of it depends on our audience here. So if you want, you're welcome to put in the chat, and I can see what kind of audience we have, whether we have people that have an S Corp and they're already doing a payroll situation and they've established their business, or some people maybe are in startup mode and they're thinking about starting a business and they want to kind of know which direction to go, or you're at the front end and you have your LLC and you haven't quite done the S Corp component yet. But how much should I pay myself? If you're just starting out as a sole prop or an LLC and you're not an S Corp, that's kind of just by default, whatever's left over from your expenses is what you paid yourself. Now, so we have a single owner LLC, wonderful. So basically your payroll, or what you pay yourself, is just net of whatever you made for the year, for the month, after your net of your business expenses. Now, when you elect to be an S Corp, now you're supposed to pay yourself a reasonable salary, which one way that like a CPA or an accountant will help you determine that is by looking at kind of the marketplace around you. And if you had to hire someone in your role doing your tasks, what would you pay that person? So that's why there needs to be enough in the business to even get to salary mode, because if there isn't enough to pay yourself salary, then it doesn't really make sense to do an S Corp. On top of the fact that when you select an S Corp, there's a little bit more expense because now you have to file an S Corp tax return and do the payroll expenditures for the software or whatnot. So a lot of times when I was talking about the progression, people have like a roadmap, if you will, of like, okay, if this business works, I'm going to start as a sole prop, then I'll do the LLC. Because here in California, where I'm at, an LLC costs $800 a year. In other states, it's a one-time fee or a lot lower.
I think
So
corporation filing here in Georgia is $60 a year or something like that. It's a lot less.
yes, in California, it's a little bit more cost prohibitive, where it's like, okay, I want to see if this business is actually going to be, viable before I start investing in an LLC. And then once you have your LLC, then you can decide at what point does it make sense to start an S Corp and pay for the separate S Corp filing fees and an entity startup fees, whether it's talking with a lawyer to make sure you have the entity set up properly, or bringing on a CPA to pay for a separate S Corp filing. So there's kind of rules of thumb depending on who you talk to, which CPA or which advisor, in terms of, okay, when should I select the S Corp? How much money should I be making to select the S Corp, where it makes sense to pay however many thousands of dollars it costs to do the S Corp tax filing and to pay for the the payroll software. But it's probably not less than 50 grand. If you're still around $50,000 a year, maybe it makes sense to stay in an LLC mode. But as you start getting to 100,000, 150,000, again, these are just estimate ballpark numbers, but then it starts making sense to do the S Corp because of the savings you can get on not having to pay the full self-employment tax when you can split your income from W-2 versus just an owner draw, which avoids the payroll tax.
Yeah, and I can see running the numbers with someone who has done this before and who's an expert in advising businesses can really help. Like, okay, at what point does it make sense? Does the pendulum swing the other way? Okay, it's going to cost less to be an S corp. It's going to cost less to do this. So
Yeah,
that's really interesting. I have another question here. I'm a single owner S corp. How much is a reasonable salary I should draw? I think you already talked about that. Is there any number or percentage recommended? Is there a percentage that the IRS says is reasonable in quotations?
yes, wonderful question. Thanks for asking that. So again, it kind of goes back to like the IRS has requirements, but they don't necessarily give us the answers. It's kind of like you know, a double-edged sword. Like they want us to pay the tax, but they don't necessarily tell us how much to pay. You kind of got to figure it out. So that's kind of a conversation. What the spirit of the law is, what the IRS is trying to get at is they don't want someone making, for example, a couple $100,000 a year in an S corp, but they're only paying themselves like a $10,000 salary. So now they basically only pay $10,000 of self-employment tax, which is like Social Security and Medicare. You can see how the government wants people to pay into that, so those social programs are funded. And then, if someone's paying themselves 10 grand salary, then the other 150,000 is just a distribution that they don't have to pay any self-employment tax on. Now, there's some negatives to that personally if you're to do that, because now you don't have any Social Security, a history of Social Security being paid into. So it would be nice when you get to age 70, for example, that you get some sort of income from Social Security, $3,000 a month versus, nothing or almost nothing because you didn't pay into it. So there is kind of that, massaging of like, you don't want your salary to be so high that you're just paying all the taxes through the W-2, but you don't want it to be so low that you don't get any Social Security later down the road when retirement becomes more of an option. And someone might argue, well, Social Security is not going to be around anyways. That's a different discussion for a different day. But great questions. And so is there a percentage, like unfortunately, they don't really give you like a nice clean cut rule of thumb. Like, hey, if you're making within $100,000 and $200,000 a year, give us a 50% W-2. They don't really do that. They try to make you justify it based on what's reasonable for your duties and but there is, kind of like a
There's a
ballpark.
range. I'm assuming there's a range that,
They
that
don't
you
want
can.
to do this. And if someone is on the call and they didn't necessarily feel like they were in a position or wanting to hire like a full-blown CPA to do their taxes every year, maybe you can find one that would at least consult with you for an hour and just let you know that you're not, raising a red flag from an audit standpoint by what you're paying yourself.
Okay. And can you talk about direct distributions? So are they, you said they're taxed differently. Can
Yeah.
you talk about that a little bit?
Yeah. So basically, if you're an S corp here and someone asked the question, I'm not on W-2, it's a direct distribution without payroll. So that's kind of a sign that you need to get more compliant. You need to have a W-2 when you're an S corp. That's kind of just the rules. So that you have a to-do item now post this meeting is to start getting a W-2 going. But with an S corp, just to make it simple, you have your revenue right for the year, and then you have your operation expenses. So whatever your cost is to run your business, and in that operation expenses also your payroll, which would be paying yourself your W-2, right? So let's say you make, just to make the numbers easy, you make $100,000 for the year, and your operation expenses, including what you paid yourself, is 80,000. What's left over is a $20,000 net profit to the business. Well, that $20,000 net profit to your business is going to flow through to your tax return as income that you're going to pay federal and state tax on. So that 20,000, in theory, was what you were supposed to be just collecting from your business as a draw or as a distribution or a dividend. The example would be like if you owned a publicly traded company, shares of a company like Apple, if you own 10 shares of Apple, you're going to get a quarterly dividend for owning that company. And those dividends, you don't have to pay payroll tax on those because those are dividends from the company. You're not going to pay Social Security and Medicare tax on dividends from being a shareholder owner, but you are going to pay federal tax based on your 1099 that you get at the end of the year. So very similar to when you own an S corp, you're not going to pay tax on the dividend for payroll tax that you take. But now it's up to you as the business owner to kind of manage that cash flow throughout the year, because there's been many a business owner, especially in the few years of owning a business, that the tax person will tell you come tax time, hey, congratulations, you got a $20,000 profit. Now you owe, $5,000 of tax. And then the business owner says, well, where's that profit? And I don't know where that tax money is. So it's up to you to kind of, and we'll get to that probably soon, manage the cash flow in your business so that you're getting the reward of some sort for a quarterly distribution, and you're paying yourself as well a reasonable salary. So you're getting the best of both worlds of being a business owner, as opposed to the worst of both worlds. A lot of business owners, they're taking all the risk, but they're not getting any of the reward or any of the benefit.
All right, well, let's pop on over to budgeting and cash flow. We have a couple slides that we put together some questions about this. And keep those questions coming, folks. These are great questions. We're happy to address those.
Yeah, well done. A lot of fun. So budgeting, how to create a budget for the business and stick to it. I mean, there's all kinds of ways to create budgets and stick to them. In some ways it's similar to a personal budget, right? You got to kind of know your numbers and know where the money is going, and be looking at your bank statements or your credit card statements. So much of it is just having an awareness, as opposed to if someone were to ask you at the end of this month, how much did you spend in your business? And you have no idea, that's like a good starting point to say, okay, I at least need to have an awareness of what a ballpark. I can't be a total guess. So that's one place to start. An easy place is just being aware. But once you're aware of what your business is spending, a way to help you stick to it is just to be more in cash, is more of a cash-based budgeting plan, as opposed to spreadsheet based. Like you look at your spreadsheet on your business and you say, okay, I think I can afford this. I think I can't, based on the numbers and how things are, flowing through my balance sheet. I'm biased towards having separate bank accounts within your business that are for the item that you're spending it on. So if you have for example, an operation expense business account, it's easy to stick to your budget, because if the cash is in there, then you can afford it. If the cash is not in there, then you can't afford it. It makes it very simple and clear from a business owner standpoint, in terms of running the business and knowing which levers to pull when it comes to spending stuff and having even big capital expenditures. Now, someone might say, hey, I can't really run my business on cash based because I have so much capital and I have to have a business line of credit when the seasonality of the business goes up and down. In order to make payroll during the busy season, I have to run it through some sort of a financing solution, whether it's taking a loan or a business line of credit. But I would submit that you can, over time, no matter how big the business is, work towards kind of a self-sustaining cash flow model, where you're creating opportunities through your business with cash you've saved in the business on purpose. In other words, you don't have to have a process where you have no idea if you can afford stuff, because you're taking loans here or bringing on partners there for equity sharing to get more capital. So that's kind of a sticking to a budget outlay, is being cash based and having that kind of philosophy of separating the main things in your business into separate accounts, so that way you can see right away when you pull up your balance sheet, okay, I can afford this or I can't afford this. Yeah, keeping business expenses under control, that kind of just goes along with the same idea, is having an awareness of how much your income is, and how much you can afford. Yeah. let's see, we move on to cash flow. A similar topic of budgeting is cash flow. How do I manage cash flow effectively? How do I use financial statements to make business decisions? And then how do I project sales and revenue for my business? So I'll tackle the first one, how to manage cash flow effectively. I'm a fan of the book Profit First. So some of you may have heard of that. You can put it in the chat if you've already started to implement that or are curious about it. But it's just that this idea of what I was talking about before, where you have certain accounts in your business that pertain to each category. So the main categories are a revenue account where you're bringing in all your sales, an operation expense account where you're paying for all your expenses, right? Your credit card fees or your credit card, payments. An owner's salary, which is what you're paying your salary through, your W-2 salary if you're an S corp. You have a profit account where you're taking your profit draw from, that you're kind of accumulating profits throughout the quarter as income comes in. And the last one is tax. You have a tax account. So those are the kind of the 5 main accounts: revenue, OPEX, owner salary, profit, and tax. And then it's up to you to kind of select the percentages that you're going to allocate the revenue to each month. So the revenue account kind of fluctuates up and down throughout the month as you transfer funds to the other 4 accounts. And then you're able to know really quickly and intimately what you have available for your business for payroll, taxes, operation expenses, and then a profit or a reward every quarter.
I
And then
will. Oh,
go ahead.
yeah, I will interject that we've done a whole webinar about this system. And so I'm going to put that in the chat. But if you are listening, or if you aren't able to, write this down, all you have to do is go to advicechaser.com and search for our small business webinars. And this one's called How Small Businesses Can Be Profitable in the Midst of Inflation.
Wonderful. And then how to use financial statements to make business decision. There's really only 3 main statements. There's the income statement, which is the profit and loss, P&L, the balance sheet, which just is assets minus liabilities equals equity, and then the cash flow statement. And when it comes to making decisions in your business using reports, the one that really is the main one is the P&L, because that shows income as it's flowing through your business month by month, expenses, and then net profit. So really all business owners want to know, am I profitable or not? And how much profit do I have? And the main way that I like to use the income statement is by always comparing where I'm at today to where I was, whether it was a year ago or even a month ago. Because if you just look at your income statement alone by itself, it really just kind of gives you an update. Like if it's year to date, so if we're here in June, so it gives you year to date, for example, from January to June, how much came in, how much went out, and what was my profit. It doesn't really tell a story of how you're doing, how should you make changes so the rest of the year is better. But if you compare it to last year, then you could start to see, okay, am I in growth mode? Am I in shrink mode? You would want to know right away if your profits are 20% less than last year, and you thought that the business was going normal. That would be kind of a code red moment where it's like, okay, what can I do here? Can I update my expenses to start being more profitable? Do I need to start doing campaigns to bring in more clients or customers? So always comparing. And so if you have a bookkeeper, kind of training them to get into a process of anytime they send you a report, a P&L, always have 2 columns with the previous year or the previous month, because over time you'll be able to know in your business which seasons ebb, which ones flow. Looking at it even quarter by quarter is a good practice. That way over time, after having a business for years, you don't have to necessarily freak out if a quarter's low, if it's always been that way. It's more of a seasonality thing, and then you know when to schedule your vacations. So it becomes a tool for managing your calendar. And that last point there on projecting sales, how to do that. It even becomes a tool for projecting sales, because or projecting revenue for your business. Because if you look at the past 5 years, for example, and the average is a 20% growth rate for income, then that could be a good, useful, like fact-based projection, as opposed to just making up a number, I hope, or hoping to grow a certain amount. If you can look at your past and see how it's been growing, then you have a more evidence-based way to project sales. In general, I'm not a huge fan of projecting sales, because it's like you can't really make plans off of projections. It's nice to know in terms of like maybe from a retirement planning standpoint, or a like an exit planning strategy standpoint. Like you can see like, okay, if I keep working at this pace for 10 more years, how much could I possibly save if I just compound that profit by 10% each year? That's kind of an easy present value, future value calculation. And the other reason I'm a big fan of looking at the past and to compare it is because it allows you to have a little bit more encouragement and motivation. It gives you a little bit more perspective as a business owner as far as how well you're doing, because you're looking at where you were, and it's easy to forget, especially for business owners. It's easy to forget where we were and how far we've come, because it's so hard to run a business. It's hard to manage people. It's hard to get new sales, to be consistent with making money, that we tend to beat ourselves up, especially when we're looking to the future and where we want to be, where we could be. We tend to get a little bit depressed or anxious. But when you're looking at the past and the gap that you've covered from where you started, it's a good reminder of like, okay, yes, I am growing. I'm doing a good job. I'm moving in the right direction. So it's kind of a twofold looking at previous comparisons. One is the obvious, like just seeing how your business is running, but the other is maybe not so obvious, which is like an internal value to getting motivated or some encouragement.
We did have a question here, a couple questions. I'm going to address one and then I'm going to wait on the other one.
Okay.
Are there particular accounting tools or software that you would recommend as far as keeping track of these kind of things?
Yes, wonderful question. Thanks for asking that. Yeah, the main ones, the main software accounting tools is like QuickBooks. And there's QuickBooks Online, there's QuickBooks like desktop version. That's if you talk to like a CPA or a bookkeeper, 9 times out of 10, that's going to be the one that they recommend or that they are just used to seeing. But if you're in startup mode, if you're here and you're in startup mode and you want to like kind of cut costs and be as cost effective as possible, there's also free ones. One's called Wave Apps, WAVE, and it's just as useful as QuickBooks. It might not have all the like bells and whistles when it comes to like invoicing capabilities or other like access to like contract workers or something like that. But Wave Apps is a free one, and you can still connect your bank accounts to it, and it'll reconcile your accounts, and you can flow through it the same way for QuickBooks. Xero is another one, XERO, that I've heard people using, and maybe even a little bit less of a price point than QuickBooks. But those are 3 examples of probably the main ones that I've seen: QuickBooks, Xero, and Wave Apps.
And I know there's industry specific ones as well out there. So it does depend. And of course, I'm assuming your accountant's gonna, as long as they can get the information they need,
Yeah,
they're not gonna care too much.
yeah. And what I listed there was more bookkeeping tools.
Mhm.
Accounting, you're looking like accounting like for tax preparation. That's different. That's more like Tax Act or what's the main
Like
tax?
TurboTax and things like that. Is that what you're talking about?
That's more for tax preparation when it comes time
Right.
to file
But
tax.
bookkeeping, yeah. Okay. So we had some questions on loans. So let's go ahead and hop on over to debt and obligations. So we did have a little bit of where a question. I'm going to start off with the question we got in the chat first. What financing or capital loans or grants would you recommend looking into?
Right. Well, when it comes to grants, the first thing I think of is SBA, like the SBA Development Center. So your town or county should have a small business administration office that is pretty much invented for that. The country created that for business owners that are looking for some capital help. And a lot of times even those SBA centers have consultants or people that kind of just offer their time, volunteer for free. There's an organization called SCORE, SCORE, that you can look up that has people that maybe have had a full career owning a business and now they're maybe in retirement mode and they want to give back to the community. And so they just volunteer their time to help people strategize and find financing or capital. So the SBA is kind of the go-to in America. And then outside of that, you can get more creative and you can go directly to, if you have a relationship with a community bank or a credit union, those tend to be a little bit more oriented towards small businesses than say maybe some of the bigger banks like Chase or Wells Fargo or Bank of America, which still might be a viable option. But you know, you can go the bank route, you can go the SBA route, and then you know there's of course the more like friends and family route. You know, people that maybe care about you, trust you, or want to help you, and have some capital that you know isn't necessarily being utilized, and you can offer them some sort of terms for investing in your business. And you know that's more of the debt route. There's other financing route where it's more like sharing equity and giving people part of the business in exchange for capital. So hopefully that's some good info on looking for financing, capital loans, or grants. But looking at the slide here, how to manage debt and pay off loans. That's actually another account you could create in that 5-account system that I said before: revenue, OPEX, salary, profit, and taxes. If your business has a heavy use of debt or loans, you can create a separate account and call it loan payment or loan payback, and use that account to manage your debt payback and pay off loans over time. Some businesses they take out a loan and they didn't really want to, but they knew they had to just because of the capital that was required, and then they're just hyper motivated to pay it off. So, and maybe instead of paying themselves an increase in salary or more profit, or even adding more expense to the business, they just hyper fund everything into the debt because they want to get that removed as soon as possible. Should I lease or buy equipment for my business? A lot of that is philosophical. Some business owners, they just want to own. They don't really care if the lease has better terms or if someone will, you know, maintain the equipment and keep it new and you know, offer some sort of a warranty of sorts. Some people do, they just want to own it and they just want to use it for as long as possible, and they're not concerned about having the best and newest and greatest features and technology updates. Other people, they want to lease because they want the newest product every 2 years, right? They kind of can re-up into a lease and get a new, you know, for example, like a new phone or a new car. But if it's equipment, leasing allows for that kind of maintaining an update of equipment. But also it might be just as simple as not having the capital to buy the equipment. Sometimes it's just there's no option. Like, hey, it's nice to know that I could buy this, you know, tractor for $300,000, but I only have $3,000 a month that I can allocate towards this. So then you have to lease it. So sometimes leasing is more about speed to get up and running before you can actually accumulate capital and buy things. You know, there's some tax considerations whether you can, you know, some equipment you can depreciate, and that's a benefit to owning it. So similar to this next question here, which is, should I buy an office or lease? Again, some people don't even have the option to buy. So it's like, unless you have a down payment, you know, 25% down on a $1 million property is $250,000. Maybe you don't have the capital yet to buy it, and so you just lease the office or the warehouse or whatever you need for your space until you can buy it. But you know, the benefits of owning the office building is now you have another asset, and you can basically pay yourself rent and write that off as a business expense. So lease is more for speed, I would say, and getting up and running and not having to own it. And there's even like some maintenance benefits. If you lease a building, you don't have to necessarily, I mean, you can call the property management when there's problems and they'll fix it. versus owning a building. Now you're on the hook for repairs and maintenance, but you get depreciation write-off, which is nice in a building. So that's a tax advantage.
Yeah, there's pros and cons to each of these, and I'm assuming that this is something that like you're stepping into as your business is growing and as you're expanding. A question here about renting or leasing an office space. Let's say that you're in a single person office and maybe like it's a work sharing sort of place.
Yeah.
At what point do you look at your revenue and say, I can afford to go up in size either to a new office, or I can afford to do, increase my business this way?
Yes. Yeah. One way is just looking at your operation expense account. All right. Assuming you have all your accounts set up, your profit and your tax and your operation expense. If your operation expense account starts ballooning, because let's say you're putting 20% of every dollar you make is automatically going into the operation expense account every month. If you start having extra capital in there, then you know what to necessarily do with at this moment. Of course, there's always ways to spend money, right? There's software, there's payroll, there's more people to hire, more ways to spend. But that's kind of a switch you can flip, or a triggering point of sorts to know, okay, I have this kind of ballooning operation expense account, because the whole point of having the OpEx account isn't necessarily to get it to just have more money, because you're not really getting anything for your money when it's in the operation expense account. It's not like, usually business savings accounts and business checking accounts don't really pay much interest, 0.01. So the idea is to get a flow of things where you're utilizing that capital to continue to grow your business. And if you see that you consistently have an extra few $1,000s in there per month, then maybe that's a good sign that it's time to get your own office if that's what you want.
And I'm going to go ahead and go to employees, and let's talk about hiring people.
Yeah, very similar. Some of it's, again, goes back to philosophy and what you want. When I talk to business owners as clients, I start with, okay, what's important to you? Where are you trying to go? What's the end result? What kind of lifestyle? I try to go backwards from lifestyle as opposed to go backwards from just income, because you could have the income, but you could be miserable. Versus, I think there's a way to do both, where like you're living the lifestyle you want and the income if you start at the front end. Because a lot of times business owners, they just kind of start going, and wherever the money's coming in from an income standpoint, that's where they keep flowing and going. But before they know it, it's like, why do I hate my life in terms of like the work I have to do and the clients I have? I think there's a way to do both. It might take longer to get the lifestyle you want and the income, but in the end, it's just such a so much better. It's just a better way to go about it. So again, with the lifestyle thing, if your idea is to be more like a solopreneur, streamlined, like slow and steady wins the race, and you want to just have more control over the business and less people to manage, then you're probably going to go more the independent contractor route, where you're not necessarily on the hook for employee benefits and kind of workman's comp and building out a whole employment track and promoting people and kind of having a hierarchy of sorts, an enterprise. You can definitely do it now more than ever with all the technology that's available. We're in a day and age where, just having a really great business from an income standpoint and a lifestyle standpoint is possible with not really having any formal W-2 employees. But some people, they want the ability to have more influence and help more people and provide jobs and or just the style of the business. Like if it's a restaurant, it's a lot harder to be a solopreneur in a restaurant than say being just more like a graphic designer. A graphic designer, you can just contract out everyone, and then if the contractors aren't working out, then you can just part ways and find another one without necessarily having to go through the whole rigmarole of terminating people and dealing with unemployment and all that stuff. But if you have a restaurant, you have to probably start getting good at hiring people and just including that as part of your business model. So in that example, again, going back to our accounts, you'd probably want to have a payroll account if you have a lot of people on staff. a payroll account. That way, you know every month how close you are to meeting payroll or not. It's a big enough line item, in other words, on your profit and loss statement, that it makes sense to separate your payroll from your operation expenses if you have a bunch of employees.
All right, let's go in and talk about taxes. We've talked about them a little bit, but taxes are an important way to save money as a business. It's important to pay the taxes.
Yeah.
So let's talk about that.
Yeah, absolutely. On the paying the tax front, that's where that tax account is so important. And just putting, for example, 15% of whatever you bring in every month into a separate tax account. That way, every quarter you have the money to pay for the estimated taxes, or come April, or if you extend to September, you have the money available in the tax account. It's not that fun. It's not that, sexy, if you will, to just be saving money into a tax account and waiting to pay it 10 months later. But at least you don't have to worry and stress about, being in trouble with the IRS or having to start paying off IRS loans. When it comes to tax advantages of being a business owner, I mean, that's pretty much the best way in America, in my opinion, to tax plan, is to be a business owner. In other words, an employee has much less options to do things tax strategy wise than a business owner. Someone might say real estate is another way to do business tax planning, but there's an argument to be made that being a real estate owner is a business owner, because you have to still manage the real estate, whether it's commercial or residential. Even if you have a manager, it's kind of a business. It's maybe more passive, but that's why there's so many more benefits, because businesses just have more ways in the tax code to strategize. So let's just go the route of someone who's an S corp, which the S corp entity selection is probably one of the main ways to get the tax advantage, like I was talking about before. Because when you're an S corp, you can split your W-2 from your profit draw, and the profit draw saves 15%. So if you're making 100 grand, you just saved, $15,000 by taking that as an owner draw, because you don't have to pay the payroll tax. Now that assumes you have plenty of income and you're paying yourself a proper salary. But just that ability alone to split your W-2 income from your distributions is enough of a reason to be a business owner, in my opinion. And then there's all kinds of stuff, within the business that you could do. So like in your house, you can have an office, and that office, you can pay yourself a reasonable rent. And now that becomes a rent that you're paying yourself, but that you're deducting as a business expense. So if you pay yourself $6,000 a year for your office, that's $6,000 that you don't have to pay tax on. So, maybe you save yourself a couple grand on taxes for having some sort of a home office that is designated to work at, whether it's in your back unit or a garage or a separate room. And then, the mileage thing, you can write off mileage if you're like a realtor, for example, and you're traveling to go see houses, or you're a marketer and you're going to see clients. It's like it's over 50 cents now. Basically, 50 cents a mile you get as an expense through your business for using your car. And you just have your app like Mile IQ, and it tracks your mileage. And then at the end of the year, you just submit all of your miles, or you track them month to month. There's something else called an accountable plan. If you're incorporated as an S corp, you have what's called an accountable plan, that you as the business owner can put all of the expenses that you've spent personally and get basically reimbursed for every month. So it's like a spreadsheet, and you could put on there, let's say you have a cell phone, and you can say that 80% of that cost is business. So now you can write off 80% of your cell phone bill and reimburse yourself through the business as a line item. So you have your accountable plan. So if you're an S corp and you don't have an accountable plan, make sure to get one of those, or ask your tax preparer to help you get that, because otherwise you're missing out on quite a bit of tax deductions that you can justify. So in other words, if it's not 100% business expense, like say you have software that you're using for your business, that just goes as a regular operation expense. But let's say you have a bunch of stuff that's like half business, half personal, whether it's like Healthcare, like if you have personal healthcare that you're paying for, that premium you can reimburse yourself that premium that you're paying for health insurance through your business, which is pretty substantial. It can be a pretty substantial savings. And then there's other more creative tax saving options, like if you have kids that are under age 18, and you can hire them of some sort through the business. Again, depending on their age, is going to dictate what they can do. But even really young kids can be, models for advertising, for Christmas cards, or mailers, and you can pay them a reasonable fee. And basically, if it's under around $13,000 a year that you pay your child, you don't have to pay any tax on it. And now you have to justify paying that fee based on what the work they're doing, whether it's shredding papers or helping clean the office or doing social media, depending on their age. If they're more like 15, 16, 17, then you can hire them out, or you can hire them for more reasonable things. But if they're like 6, 7, 8, 9, they're not going to be able to do as much stuff. But that payment that you pay them, let's say you pay them $6,000 for the year, that's basically tax-free income, because they don't have to pay any tax on it, and your business gets to deduct that as an expense through the business. You still have to make sure to do a W-2 for them, but you don't have to do like a 1099. You just do a W-2 and pay them W-2, but you don't have to pay any tax on it. But that's a strategy you probably want to include a tax preparer in, just to make sure you're getting the W-2 stuff right and paying them a reasonable salary, and not raising any flags. And then if you want to take it even a step further, with that $6,000, you can fund a 529 tax-free college account for them, or you can fund a Roth IRA for them, which you're kind of setting them up for some serious compounding, decades worth of compounding, when you start doing stuff like that. So those are some ideas when it comes to minimizing taxes as a business owner.
Well, that's a great ideas.
Yeah. What are tax implications for hiring employees or independent contractors? I mean, the main thing is those become expenses in your business that you get to write off as a business expense. Employees have a little bit more parameters and compliance than, say, independent contractor. I'm here in California, so even the rules with independent contractor are tighter. In other words, it's harder to justify someone's an independent contractor in California, because California wants employees to have access to employee benefits, essentially.
All right, we're rounding out our questions here. We've got a couple more. Let's talk about this could be a whole webinar, but maybe you can just talk a little bit about needing to set up retirement for yourself and or people that work with you. Talk about that a little bit.
Yeah, absolutely. No, it's been fun. Thanks for everyone being on the call and answering questions, and hope it's been helpful. Feel free to pop in more in the chat if there's any more as we wrap up here, any more questions. But retirement planning, I'll kind of run the gamut of simplest to more complex. The easiest is just an IRA, individual retirement account, or individual retirement arrangement. And that could be a Roth, which is you put it in post-tax, and then it hopefully grows tax-free, and you pull it out, not paying any tax. And you don't even need to be a business owner to have an IRA, right? You just need to have earned income. And then there's, a SEP IRA, SEP IRA, where you just basically pay yourself a percentage. You choose a percentage up to like 25% of your income for the year. You put it in, and you get a tax deduction, and you just have an IRA. That typically isn't chosen for businesses that have a bunch of employees, because you have to put that same percentage that you put for yourself into all your employees for a SEP. There's a simple IRA, and it's like it sounds. It's supposed to be simple in that you don't have to do the same compliance testing as like a 401k, but you can still give people access to some sort of a funding mechanism where they could put in like $13,000 a year, your employees, and get a deduction, and you would be matching them like 2 or 3%. So they still get a little bit of a match, but you have to manage each individual simple IRA and make sure payroll gets into each account. So it's actually not as simple as it should be. So it's almost the worst of both worlds, the simple IRA, because you don't get the full 401k, but it's not as simple as like a regular Roth IRA. And then moving forward from that, it would be like a real 401k with like maybe a safe harbor component where you're matching, up to 4% of whatever the employee puts in. So you're matching up to 4% of their salary per year. If they match, you match. And then you as the employer can put $20,000 or more into your own 401k. And then you can also choose to do profit sharing and put a profit sharing amount into all of your employees. And there's also a little bit more creativity you can have there in terms of choosing who gets profit sharing and how much, if you want to reward like certain employees, key employees. So those are kind of the basics. Outside of that would be what are called more defined benefit plans, like setting up a pension. So this would be maybe like a surgeon's office who has like one or two assistants, and they want to be able to create a pension for themselves. And in those examples, you can put hundreds of $1,000s a year into a defined benefit plan, and start to create more of an endowment fund for yourself.
Well, I think that's about all the time we have today. We have filled our hour, and I want to thank Eric for being here. And I want to thank all of our great participants for putting your questions in the chat. You're still welcome to put more questions in. If we were not able to get to it, we will reach out to you after today's event. So if you haven't had a chance to listen to this, or you came in a little later, we will be sending out a link to the replay of this event, and you're welcome to share that replay with friends and family. We want to thank the organizations and Eric that have helped put this webinar on today. And we're so glad that you came. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.